Friends, the topic of today's podcast is sensible measurement. In investing, most of us are very keen in measurement. We believe that the more often we check investment performance, that could contribute to improving what we do with our investing. In practice, this is not generally the case. In my experience, in every bull market, when the valuations run ahead, indices or specific themes trade at very high valuations. There is only one thing that I have always tried to do. That is to identify places where there is value, yield in the form of dividend, and reasonable investment creation within the business. Essentially, these choices meant that I was investing away from the benchmarks. In 2007, when it was very difficult to find opportunities, I was investing in gold. Now, if you compare an investment portfolio which has gold with the Nifty, it doesn't make too much sense, right? The reason you're investing in gold at that point in time is because stock valuations were not giving comfort. In 2000, we were investing away from technology and the indices and looking to invest in good consumer franchises with dividend yield. As a mutual fund investor or advisor, it is more or less the same approach that we believe is safer in the long run. When the index is at a very high valuation and it is propelled by just a handful of stocks, it does not make sense to race against that index for a brief period of time, at least until sanity returns to the indices and a more broad-based movement of the indices happen. When only one theme or sector performs, it could be tech in 2000, it could be infra in 2008, and it could be mid and small caps in 2018. It is essentially the same approach which has been followed by us. Now, it is important to understand that turbulent phase, when it was too risky to invest in the performing themes, will gradually recede. And as that phase recedes, one should again go back to the path of making investments in high conviction themes which will give return over a 3 to 4 year period. Notice that I mentioned 3 to 4 year period. And typically, if one is investing in a theme to earn money over a 3 to 4 year period, the time taken to invest itself may be a year. So, if you are the kind who is looking regularly at the NAVs of your mutual fund schemes in those upcoming themes, the chances are that you would lose patience. There is another bigger risk. When markets are high and you do beat the Nifty, the quality of that outperformance is something that most of us don't look into. Most of the times, that outperformance does not sustain over the 2 to 3 year periods. Effectively, trend chasing in bull markets can only hurt. So the only option is to invest away from the trend. Either you hold cash or you gradually deploy money or you buy value. I believe in doing a mix of all three. And when it comes to the savings of a investor who does not understand how returns are created in each theme and stuff like that, it's all the more important to ensure that those investors maintain the confidence and trust in those decisions, just as those decisions come out of the difficult market period and move towards a phase when they start delivering returns. Friends, it's important that each and every one of you understand why your advisor has made certain decisions on your behalf and show patience to ensure that the benefits of those decisions reach you. By showing haste, the chances are that you may miss out of the easier part of the investing, which is waiting. Having made tough decisions, you should show patience for good things to come to you. So measurement, while it is necessary, it should not drive your thinking towards the wrong kind of investment behavior. If you are investing in a theme or in a particular sector or in one part of the market, you cannot continuously chase the Nifty. The benefit of investing away from the Nifty is that if you are right on those themes, your returns will be far ahead of the Nifty. And you can be wrong in the near term. As an investor who was mostly invested away from the indices, I thought this is a time to share that important observation and driver in my investing with every one of you. I hope you don't get excited by the impending activity in the market, the run up to the budgets and volatility, and learn to make more high conviction investment decisions in these times so that you will benefit when better days arrive. Thank you very much.